Are you tired of seeing your hard-earned money just sitting there, barely growing, in a traditional savings account? You know there's got to be a better way to make your money work for you, but with so many options out there, it's easy to feel overwhelmed. You've heard whispers of high-yield savings accounts and perhaps even Acorns for investing, and now you're wondering, which one is truly the best for your money goals? Today, we're diving deep into that very question. We're going to break down Acorns, the popular micro-investing app, and compare it head-to-head with high-yield savings accounts, or HYSAs, to help you decide where to put your money for maximum impact. Forget the jargon and the confusion, we're simplifying it all so you can make an informed decision with confidence. Let's set the stage. On one side, we have Acorns, an app that promises to make investing accessible to everyone, even if you only have a few dollars to spare. It's known for its roundups feature, where it rounds up your everyday purchases to the nearest dollar and invests the change. Think of it as a digital piggy bank that also puts your money into the stock market. Acorns offers diversified portfolios of exchange-traded funds, or ETFs, which are essentially baskets of different investments like stocks and bonds. They have different portfolio options ranging from conservative to aggressive, and they even offer retirement accounts like IRAs and custodial accounts for kids. On the other side, we have high-yield savings accounts. These are exactly what they sound like, savings accounts that offer significantly higher interest rates than your typical brick-and-mortar bank. We're talking APYs, or annual percentage yields, that can be many times the national average. While a traditional savings account might give you a paltry 0.01% or 0.05% APY, top HYSAs can offer rates upwards of 4% or even 5% in today's market. These accounts are usually offered by online-only banks, which can afford to pay higher rates because they have lower overhead costs. So, how do these two financial tools stack up against each other? Let's start by looking at their fundamental purpose and how they aim to grow your money. Acorns is fundamentally an investment platform. Its core purpose is to help you invest your money in the stock market. This means your money is exposed to market fluctuations. When the market goes up, your investments can grow significantly. When the market goes down, the value of your investments can decrease. Acorns focuses on long-term growth through diversification and consistent, small contributions. Their expert-built portfolios are designed to weather market ups and downs. They automatically rebalance your portfolio to keep it aligned with your goals and even reinvest dividends. The power of compounding, where your earnings generate further earnings, is a key principle behind Acorns' approach. High-yield savings accounts, on the other hand, are designed for saving, not investing. Their primary function is to provide a safe place for your money to earn a higher interest rate while remaining easily accessible. The interest rate on an HYSA is generally variable, meaning it can change over time, often in response to the Federal Reserve's interest rate policies. While the returns on an HYSA won't typically match the potential long-term growth of the stock market, they offer stability and predictability. Your principal is protected, and you know exactly how much interest you'll earn. Next, let's talk about risk. This is a crucial differentiator. With Acorns, because you're investing in the stock market, there's inherent risk. While Acorns uses diversified portfolios to mitigate risk, and your accounts are SIPC protected up to $500,000, you can still lose money. The value of your investments can go down, especially in the short term. This means Acorns is generally better suited for money you don't need access to for several years, ideally 5 years or more, to ride out market volatility. High-yield savings accounts are considered very low risk. They are typically FDIC insured up to $250,000 per depositor, per ownership category, per institution. This means that even if the bank fails, your money is protected up to that limit. This makes HYSAs an excellent choice for an emergency fund, a down payment on a house, or any other short-term savings goal where preserving your principal is paramount. The value of your money in an HYSA remains stable, it doesn't fluctuate with the market. Now, let's consider accessibility and liquidity. High-yield savings accounts generally offer easy access to your funds. While some might have limits on the number of withdrawals you can make per month, though this is less common since the suspension of Regulation D, you can usually transfer money to and from your linked checking account with relative ease. Transfers typically take a few business days. Many online HYSAs also offer mobile apps for convenient management. Acorns, while making investing simple, isn't designed for immediate access to your cash. If you need to withdraw funds from your investment account, you'll first need to sell your investments, which can take a few business days to settle before the cash is available to transfer to your linked bank account. This isn't ideal for sudden emergencies where you need cash quickly. However, Acorns does offer a checking account that can integrate with their investing features, allowing for real-time roundups and no overdraft fees, which adds a layer of banking convenience. Fees are another important factor to consider. Acorns operates on a subscription-based model. They offer different tiers. Acorns Personal typically costs around $3 per month and includes an individual brokerage account, an IRA, Roth, Traditional, or SEP, and a checking account. Acorns Family is usually around $5 per month and adds unlimited custodial accounts for kids in addition to everything in the personal plan. For very small balances, these monthly fees can eat into your returns significantly. For example, if you only have $100 invested, a $3 monthly fee is a substantial 3% annual fee. As your balance grows, the percentage fee decreases, making it more cost-effective. You should also be aware of the underlying expense ratios of the ETFs Acorns invests in, though these are typically low, ranging from 0.04% to 0.22%. There can also be transfer fees if you decide to move your investments out of Acorns to another brokerage, which can be as high as $50 per ETF. High-yield savings accounts, on the other hand, often boast no monthly maintenance fees and no minimum balance requirements to earn the advertised APY. Some might have minimum deposit requirements to open the account, but many don't. The primary cost with an HYSA is simply the opportunity cost of not investing your money for potentially higher returns, but there are usually no direct fees eating away at your principal or interest. With that said, thanks for watching and until next time.